Modern startups generate billions in global wealth, yet the vast majority of them still collapse, even after raising massive amounts of capital. Funding does not solve business problems, it only masks weak fundamentals. Yet year after year, investors lose money by backing companies based on market hype, a fear of missing out, or the sheer charisma of a founder. To evaluate a business accurately, you need structure. Dr. Bitan Ghosh developed the 11th Index specifically for this purpose. It is a practical framework designed to strip emotion out of the equation and replace it with disciplined, objective analysis. We are going to look at how this index converts a chaotic, optimistic startup pitch deck into a mathematical, data-backed investment score out of 100. Relying on a rigid, systematic structure is the only reliable way to separate temporary market excitement from long-term, sustainable business value. Instructing, step 1 of the framework requires scoring the startup on a scale of 1 to 10 across 11 interconnected dimensions. E1 evaluates founder and leadership strength. This asks the most critical question: does this specific team actually have the execution capability to build the company they are pitching? E2 measures market opportunity, while E3 looks at product and innovation. You have to verify that the target market is large enough to support the valuation and that the product solves a real problem differently than existing alternatives. E4 evaluates the business model, and E5 assesses financial strength. These dimensions determine whether the startup can scale profitably and manage its capital efficiently. Next, E6 maps competitive positioning, and E7 tracks customer and growth indicators. This is where you look for a defensible moat and hard evidence of actual customer traction. E8 covers governance, and E9 measures operational readiness. A company must be legally sound and possess internal systems that can handle rapid growth without breaking. Finally, E10 maps the investment and exit potential, showing the actual path to a return, while E11 checks future sustainability, ensuring the startup can survive incoming market or technological shifts. Startup success is strictly multidimensional. A severe weakness in a single one of these pillars can easily collapse an otherwise brilliant business idea. A startup might score high on its product, but low on its business model. To resolve that, the 11th Index applies a strict mathematical rule. The 11 dimensions are explicitly not treated as equals. This chart shows the weight distribution. E1, founder strength, carries the heaviest weight at 15%. A highly capable founder can pivot a weak product, but a weak founder will inevitably ruin a brilliant product. Compare that to E11, future sustainability, which only receives a 6% weight. The math intentionally prioritizes immediate execution capability over distant future risks. To calculate the score, take your 1 to 10 rating for a dimension and multiply it by its assigned percentage weight. This gives you the weighted contribution for that specific pillar. You repeat this calculation for all 11 dimensions, and then add those weighted contributions together. The result is a single, objective score out of 100. By forcing a weighted calculation, the index prevents an investor's overwhelming excitement about one specific factor, like a massive total addressable market, from blinding them to fatal structural flaws hiding elsewhere in the business. Cautionary: a high 11 score is completely meaningless if it is based purely on unverified claims from a polished pitch deck. Before finalizing any score, an investor must run the startup through a strict due diligence checklist. This rapid verification process is broken down into 3 main buckets: founder verification, market validation, and financial audit. You cannot trust the market sizing slide. You must check independent industry reports. You cannot assume revenue is healthy. You must verify actual bank statements. You must call founder references directly to uncover the truth. If due diligence exposes a lie, or even a major gap in the data, the 11th score immediately drops. A confident invest decision quickly becomes a definitive pass. The final score guides capital allocation. 9.0 to 10 signifies an exceptional strong invest. 8.0 to 8.9 indicates a strong candidate. 6.5 to 7.9 places the startup on a watch list for fixes. Below 6.5 is a hard pass. Risks outweigh returns. This final number gives investors a bias-free shield against emotional errors. It uncovers hidden vulnerabilities long before any capital is actually deployed. Founders can use this exact same framework internally. By scoring their own company before stepping into a pitch meeting, they can use it as a diagnostic tool to identify and fix business weaknesses early. Consistent startup success requires disciplined evaluation. To start making smarter, data-backed decisions, download the Master Scorecard in the description and subscribe for more deep dives into the mechanics of investing.